We're going to calculate the stock price for Suncor Energy. Now the first step is we need the market cap, and that's 26.16 billion, and the stock price is 17.12. And now we figured out the shares outstanding, because the shares outstanding is just a market cap divided by the stock price. So they have 1.5 billion shares. Next we need free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow and discount that number back to today's dollars. And that's exactly what we're doing here. So we need 4 years of free cash flow. It looks like that a negative year. But hopefully that doesn't affect the model too much. A lot of people ask me to value companies, but they have negative free cash flow and negative net income, so there's no way to value those companies. It's less than zero. Not that the stock is worth less than zero, it's just the valuation is, and you can't look at the current numbers, you have to project the future, and that's not what a DCF model is. So now that we have all the financials in, and you can take a quick look, net income, it was pretty weak in 2016, but then it jumped up the following years, and revenue jumped, and then it kind of stayed steady a little bit. But let's look at the capital structure, because now we need to look to figure out what the discount rate is to apply to the future cash flows, and that's using their capital structure. So first we need the interest expense. That's the interest they pay on their debt. And next we need to find out how much debt they have, and we go to the balance sheet for that, and we go to liabilities, and then current liabilities, current debt, that's the debt due within a year, 2.2 billion, and long-term debt is due after 1 year, that's 13 billion. So they pay a hefty interest rate, 6.6%. But interest is tax deductible, so let's find their effective tax rate. We'll go back to the income statement and the income before tax. This is why it's hard to look at the income statement. Things like this. In 2019, they made $2.5 billion, but they had a $366 million reversal in taxes. So they actually got a refund of $366 million instead of paying, even though they made $2.5 billion. Because the income statement looks at prior years also, which makes it really difficult, because there might have been a loss in a prior year, or an expense they're putting through this year that happened in the past. So that's why it can be a little challenging. Let's do the prior year. That seems more accurate. The income before tax, and now the income tax of 1.7 billion. So 34% taxes, that seems about right. So the cost of debt is 4.4%. Now to find the cost of equity, we just need the beta. And the beta is 1.7. That's the volatility of the stock, how it moves with the market. And to calculate the cost of equity, we use a CAPM model, capital asset pricing model. It's a pretty simple model. You can just Google that term. The cost of equity is 15% compared to the cost of debt of 4%. So obviously equity is more expensive than debt, because equity sits lower on the capital structure of a company. So in the event of a default, debt holders are paid before equity holders. So this number, 11.35%, is the price Suncor pays to obtain financing. So Suncor needs to generate at least this amount of profit a year to add value to its investors, and if it doesn't, it will eventually go bankrupt. But this is their discount rate. It's a blend of equity, the cost of equity and cost of debt. So 11.35%. We're going to discount future cash flows by. So we calculated the next 4 years of free cash flows based off of prior financial information. And we did a terminal value, which is all future years after year 4. And then we discount those numbers back to today. And the value of the company is $20 billion. And when you divide that by 1.5 billion shares, we calculate the stock price at $13, and it's trading at $17. So it's trading at a 31% discount. So we consider this a sell. And It was trading well above intrinsic a few months ago. It's come back a lot closer. But stocks can trade higher or lower than intrinsic value. The stock price is really predicated on the supply and demand of the market. The more people that want to buy a stock, the higher it goes, and the more people that want to sell a stock, the lower the price goes until they find a price that works for both parties. So some analysts you'll find will say buy this stock, and others will say sell this stock. But each analyst uses their own model and their own assumptions. But you never actually see their model. This is my model and my opinion, so thanks for watching.